What is asset allocation? I recently came across an article that explains that. Asset allocation is a common word that most of you would come across once you step into the world of investments. It is a diversification strategy. It needs to be followed in order to position your portfolio for optimal performance. According to Richard Kane of Meyer Asset Management Limited Japan, asset allocation is one of the most critical decisions that an investor needs to take. A proper asset allocation plan is what sets apart a high-performing portfolio from a mediocre one. One of the first points to keep in mind if you wish to make asset allocation work in your favor according to Richard Kane of Meyer Asset Management Limited Japan is to assess your risk tolerance level. Every investment vehicle in the market entails a certain degree of risk, which needs to be appropriately matched with your risk appetite. While fixed income investments generate lower risks, they also generate lower returns. The reverse is true for investment vehicles with higher returns. Richard Kane of Meyer Asset Management Limited Japan says that once you are certain about the amount of risk and volatility you are able to handle, you can then continue to build your portfolio from a choice of mutuals, equities, hedge funds, bonds, fixed income and alternative investments as assets. They explains that your asset allocation strategy should strike a balance between accomplishing your needs and not exceeding your risk tolerance. While most would prefer to see double-digit returns, not everyone has the capacity to stomach that amount of risk. This is why the concept of balance is of utmost importance. A well-balanced portfolio almost always does better than one which promises higher returns by compromising on the security of returns, since the market can be highly unpredictable. Richard Kane also explained that age and objectives have a lot to do with setting the right asset allocation plan for oneself. Ideally, your asset allocation plan should be revised as and when you get older. When you are young, you are able to play around with investments that fetch long-term returns as they have time on their hands. However, those in the older age bracket should consider less volatile investment vehicles with fixed income when putting together an asset allocation plan. Thus, starting younger on your investment strategy definitely makes the most sense, but it is never too late to begin investing for a better future. Please like and subscribe to my channel for more financial related topics. See you in my next video.